Hi, this is Bitcoin Asset Research with Allard. Today I'm going to talk about Bitcoin's new S&P 500. This is referring to the OWNB ETF by Bitwise. So they just launched this Bitcoin Standard Corporations ETF on March 11th, so just 2 days ago. And this is definitely some very exciting stuff. So when an economy gets big enough, it tends to get its own equity indices and equity index ETFs. You can see this time and time again. The UK has the FTSE index, Japan has the Nikkei, Germany has the DAX, China has the CSI, and the US of course has the SPX or the S&P 500. And these are roughly overlaid with their respective fiat currencies. These are the 5 major fiat currencies. Now, Bitcoin is already becoming a major global currency. This point really cannot be disputed. When you look at the top fiat currencies by market cap, you actually see that Bitcoin ranks number 13 inside this entire list. Now, to be clear, gold should probably be in here somewhere, so Bitcoin would actually be ranked number 14. But the point stands that it's very impressive that something without a nation state backer behind it has emergently become chosen as money and has already outcompeted like dozens and dozens of other fiat currencies as shown in this list. So the Bitcoin economy is already emerging in the form of individuals, businesses, institutions, and nation states that use Bitcoin. So anyone that transacts in Bitcoin or saves or holds Bitcoin, this is all using Bitcoin. And unlike fiat monies, nobody has declared this value out of thin air. The market has emergently converged on Bitcoin as this form of capital that they want to use, and that definitely stands out. So any economy has equities. You're always going to have companies that produce goods and services. This is what makes an economy an economy. So right now, that list of equities for the Bitcoin economy, you can actually find that over here. This is a non-exhaustive list, but here you have the public companies that are holding Bitcoin. Some of these are actively growing their Bitcoin holdings. Here you have ETFs and other funds, so this represents the institutions. Here's some DeFi smart contracts. This is private companies that have disclosed their Bitcoin holdings. And of course you have nation states. And you, the viewer, are presumably the individuals. We all have our stacks of Bitcoin and we have the ability to buy more. Now, if you're finding this video informative, I just ask you to like it, share it with a friend, subscribe to the channel, leave some kind of question or comment. This really helps with the reach of the video, so I would really appreciate it. Now, moving on to OWNB, and what exactly is it? So this ETF invests in corporations with at least 1,000 Bitcoin on their balance sheets. So actually, this is a very good way to do this index construction, because you automatically, with this criteria, filter out for the companies that are serious. And if we just thought about this for a second, like there's only 21 million Bitcoin. A lot of the Bitcoin are already bought. There's really about like 1.5 million left to be mined. And so really like the 1,000 Bitcoin bar is quite a high bar when you really think about it. The end state of this ETF will not have that many companies. It very likely will not be an S&P 500 in the sense that there are 500 companies. Like you'll probably have meaningfully less than 500 companies ever inside an ETF like this. Another thing is that the fund does not invest in Bitcoin directly or indirectly through the use of derivatives. So you're not going to see it buying the Bitcoin spot ETF or Bitcoin directly or using futures products to imitate the price action of Bitcoin. This thing is purely an equities ETF. So that's definitely the best way to construct an index like this. This is really good. Now, when we move on to the fund summary, we can see some other numbers. So there's 21 companies that the fund has invested in right now. Got about $500,000 in assets under management. It's a very small right now, but it's not bad for something that launched 2 days ago. Pretty high expense ratio, right? 85 basis points. Like most index funds probably are no more than 20 basis points. So this is definitely on the high side of the expense ratio, but maybe it comes down over time. Now, when you look at the holdings of this company, as you can expect, strategy, MSTR, is basically at the top, and it kind of falls in rank and file based on how many Bitcoin they have. Now, there's a very interesting caveat in the way they've constructed this index. And I'm sure you could kind of scan through this and see that it's not exactly sorted by the number of Bitcoin holdings they have. Right, so you have 3,000 Bitcoin over here, and then you have something with 2,800 Bitcoin way down here, and then you have a few 1,000s in between the two. So really it's like what's going on. And of course you have some very big players, 8,000 Bitcoin over here, 9,000 here, and 11,000 here. And they are very far below the ones with 2,000 and 3,000. So there's clearly something weird going on in index construction. And to get to the bottom of that, we have to go to the index methodology. So here's the index methodology from Bitwise. We have really the specific rules of how this index is constructed. So first off, at least 1,000 is the baseline criterion, but they also throw out a lot of things based on geographic eligibility. So if something is very hard for US investors to get access to, then it's thrown out of the index. If something is too small, under 250 million market cap, that's also thrown out of the index. Liquidity is also a criteria. Float is also a criteria. So these are all pretty standard for normal ETF constructions. So this is where the constituent selection and weighting comes in. Bitwise does a two-tiered system. So there's tier 1, and these companies really, like, if you read through this, it's just companies that are serious about acquiring Bitcoin, growing their stashes, and also like making Bitcoin something that they are highly exposed to. So over a third of their current assets are supposed to be exposed to Bitcoin. So this is really a screen for seriousness. And tier 2 are the companies who have 1,000 Bitcoin, they've bought Bitcoin, but they're not like as serious as the tier 1 companies. So originally I was kind of skeptical about doing it this way. I thought, why not just like weigh everything by the Bitcoin they have? But actually, when you think about it, everyone who's looking for like exposure to pure play Bitcoin treasury companies, they're probably not looking for some company that just bought 1,000 Bitcoin and let it sit there and isn't really like actually on the Bitcoin standard. So this is a good way to give exposure to both groups, but also highly weight it towards the companies that are actually serious. So the more I think about this, actually the more I like it. Tier 2 has a maximum of 20% of the index. So what they're going to do is they're going to keep giving 1.5% equal weights to everyone in tier 2. So when we go back to this holdings page, you could probably see like Coinbase, Block, Tesla, these are all tier 2, and they have very close to 1.5% index weight. So tier 2 never makes up more than 20% of the index. And of course, as more companies enter this index and become tier 2, because you'll probably have companies that pick up 1,000 Bitcoin here or there, but they're not going to be like all in on it the way the tier 1 companies are. So this 1.5% equal weighting is going to shrink over time because this 20% is staying stagnant. So if you have, let's say, 40 companies that are considered tier 2 inside this index, well then each of those companies would only have 0.5%. Now here's some more interesting things. The largest constituent in the index, this is obviously going to be strategy, MSTR, because MSTR just has so much Bitcoin. It has like 10x more than number 2. So this is actually a very important thing. They're capping it at 20% of the index. Number 1 in the index can never be more than 20% of the index. And number 2 in the index can never be more than 12% of the index. And then number 3 will not be allowed to have more than 10% of the index. So anything that's removed from this, right, is equally distributed amongst the tier 1 constituents. So tier 2 doesn't get any additional weights, but the excess weights from number 1 and 2 in the index, which will all be tier 1, they go towards the smaller tier 1 constituents. So what does this do? This kind of creates this effect where the smaller Bitcoin treasury companies with smaller Bitcoin treasuries, they kind of gain more of a weight in the index, and it allows the index to not be dominated by the top heaviness and the immense power law of the Bitcoin distribution, right? Because right now, Bitcoin in the corporate level isn't as well distributed, right? Because you have 2 companies that have a huge amount of Bitcoin. Now, these next 4 steps kind of dictate how exactly that works. This is actually done as a procedure to retain tax advantages within the ETF structure. So here Matt from the Bitwise team, who's actually a CIO at Bitwise, he talks about tax law requires equity ETFs to meet certain diversification requirements. So the main rule here is the 5-50 rule. So constituents with weights higher than 5% cannot make up more than 50% of the fund. So when we go back over here, you see 45% and 4.5% is really like giving you that buffer zone. So this is just the procedure to ensure that there is the compliant level of diversification within this index construction. Now everything's going to rebalance quarterly. This is pretty standard for an equity index. And yeah, that's really the construction process. Of course, Bitwise retains the option to change some of their methodology. That's really it as it stands right now. So some of the things I'm seeing, right? I've copied over the holdings onto this Excel sheet and really just labeled all the mining companies and labeled MSTR and of course everything else. And this is really the breakdown you have. MSTR is like 21% of the index, but you can see that mining companies actually make up like 46% of the index. So this thing is really, really exposed to the Bitcoin mining sector, which makes sense because when you look at Bitcoin treasuries, like a lot of the top ones are all mining companies. And if you are mining, it is much more probable that you would have a Bitcoin treasury than if you were some other company. Now, I do want to note that this mining dominance thing can very rapidly change. So specifically, I want you to look at Tesla, Coinbase, and Block. These have a very large amount of Bitcoin, but they're considered tier 2 right now. Now, Tesla has a gigantic cash pile, and if they use some of this to buy Bitcoin, they can easily get to the 1/3 threshold to become a tier 1 asset within this index. So can Coinbase. Coinbase has 8 billion cash and only 18 billion in current assets. So if they use the cash to buy Bitcoin, they can also reach that 1/3 threshold. So can Block, formerly known as Square. So these companies have the ability to suddenly rise up in these ranks and become tier 1 assets and bump all of these miners down, right? So you can have this 45% mining quickly and very quickly become a significant amount of other businesses. Like Coinbase, Tesla, and Block are very different businesses at their operating business level. So while right now you're very exposed to Bitcoin mining, that does not have to be the case going forward. This is a very rapidly changing landscape. On top of that, you have a lot of other smaller companies that are coming up. This index is really based on how much Bitcoin you have, assuming you reach the tier 1 level. So as something like Metaplanet or something like Semler Scientific, as these companies accrete more Bitcoin, they're going to get higher weights within the index. So I expect that this picture is going to change very rapidly over the next year. And it's going to look very, very different within 5 years' time when a lot more companies start adopting Bitcoin. Okay, now some more implications, right? As the OWNB AUM grows from inflows, there's going to come a point where the passive inflows from the fund will actually serve as an incentive for companies to buy Bitcoin. So what do I mean by that? Imagine if the cost of 1,000 Bitcoin was equal to 1.5% of the AUM in the fund. Okay, so anyone could just pick up 1,000 Bitcoin and they would qualify for tier 2 within the OWNB fund, and they would receive 1.5% of the AUM as a cash injection into their stock. Well, now that means the company can sell 1,000 Bitcoin worth of their shares via an at-the-market program, and they can buy 1,000 Bitcoin, and this gets them the index inclusion, right? And they get that 1.5% allocation within the ETF. This perfectly offsets the dilution from selling these shares because they would have got a buyer for those shares. So what basically happened was the company just got 1,000 Bitcoin effectively for free because they were able to issue their shares and get a guaranteed buyer of the shares. Now this is of course subject to quarterly lag because OWNB as an index does the reconstitution quarterly. So you're not going to be able to pull this off and then like immediately get the fund reinjection into your shares. And now we know the current AUM is only 500,000. So at 1.5% making up 1,000 Bitcoin worth of funds. Well, you're looking at $5.3 billion in total AUM, given the current Bitcoin price of about 80,000 per coin. And I don't think this is really outside of the realm of possibility. If you look at some of the other Bitwise ETFs, here's the spot Bitcoin ETF by Bitwise. They got $3 billion in AUM. Here's the Bitwise Crypto Index Fund, and they got $1 billion in AUM. So it's not impossible that OWNB would get the amount of AUM necessary for this to become a thing. And once it starts becoming a thing, you have to start thinking that like other companies would want to buy Bitcoin just for these passive inflows. And that kind of becomes this self-fulfilling prophecy. Now, this definitely sounds like very exciting stuff, but it could also be gamed, right? So this is what I mean. Let's say a company buys 1,000 Bitcoin. They could hedge out that exposure with futures to earn the basis. So basically they'll sell the futures at above the spot price. They've bought the Bitcoin at the spot price. So as the futures and the spot converges, they're going to earn the difference between the futures, the higher futures price, and the lower spot price. Now they also bought 1,000 Bitcoin, so they would still qualify for the index, and the dilution would still be completely offset. So basically the company earned that basis completely for free. Now obviously this company isn't actually on the Bitcoin standard. It's just using Bitcoin as this trading instrument in order to do these basis trades. And then it's using the funds within the OWNB ETF as trading capital, right? So this would be a way to game this, because you would effectively be earning basis for free by employing this kind of futures trade as a trading instrument. So I definitely hope Bitwise imposes certain rules on the index construction to ensure that such situations cannot emerge. Something simple like the company has to hold that 1,000 Bitcoin for over 9 months. Something simple like that could probably work. I don't see this being like, a feasible like attack vector to really game the ETF. Certainly the AUM right now is not where it's at to make this worthwhile for companies. But this is just something to watch out for. Either way, 1,000 Bitcoin over 9 months is probably a good screen for making sure that this company is serious about Bitcoin. So here's my overall thoughts. 85 bips is pretty expensive as an expense ratio. I'm not totally happy with it being so dominated by mining companies. Again, it's going to change, so this will be something I monitor. There's a bit of an adverse selection. I've noticed a lot of the smaller companies that are announcing Bitcoin treasuries, they're extremely small, they're not profitable. The business isn't really good, and they seem like they're just punting into Bitcoin in order to get more attention. I don't want to invest in anything like that. But again, this would all change very quickly when big companies take a very large stake in Bitcoin. So this is definitely something to watch, because you're really seeing the development of this new monetary system. And of course, that monetary system will come with its own equities and securities. So OWNB overall is a great development. It's excellent news for the Bitcoin network, for Bitcoin investors, and for Bitcoin treasury companies, BTCs. I'm not sure it will outperform Bitcoin given the heavy exposure to mining stocks. And just as an interesting fact over here, like the mining companies of most commodities do not outperform the commodity. And with Bitcoin mining, it's even more perfectly competitive than mining for anything else. So we shouldn't really expect mining as a broad sector to outperform Bitcoin, right? So given that heavy exposure to mining stocks, I'm not sure that this index can do what it takes to outperform Bitcoin. But it is very likely to outperform something like the S&P and other fiat indices across the world, assuming that this Bitcoin bull market is not over yet. And I certainly think that it isn't. So if you found this video helpful, leave a like, consider sharing it with a friend, leave a question or a comment in the comment section. I hope you enjoyed it. Thank you so much for watching, and I'll see you in the next video. Bye.